Roundtable, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines that prepare you for the week ahead. I'm Jack Howe, in for Jack Otter. Coming up, the stock market has regained its swagger. That was fast. Rob Arnott at Research Affiliate says it's time to take a look at the market's least loved names. He'll tell us where the value is. And later, it's a CEO swappuccino. Brian Niccol leaving Chipotle to take on sputtering coffee giant Starbucks, but with consumers feeling the heat of higher prices, the turnaround job is a tall order. But we begin with our expert panel and three things investors ought to be thinking about right now on the Barron's Roundtable. My colleagues, Ben Levison, Megan Lenhart, and Andrew Berry. Let's start with Bounce Back Ben to tell us about the market's rip-roaring rebound this past week. Was the news all good or all great?
No, it was fantastic. We came into this week worried about recessions, and then we get a CPI number that was not too hot, and then we get retail sales that were strong. We get other economic data that was great, and all of a sudden you have the stock market has the best week of the year, the best week going back to November.
And it's not just big tech running. There are some typically sleepy sectors that have been leading the charge here.
Yeah, my favorite is that you have utilities are actually beating the NASDAQ 100 this year now, and you've also had banks and you've had real estate do well too, and these are all rate trades. Rates have come down, yields have come down, and they're doing quite well.
What do you think of those utilities, Andrew?
Utilities are finally a growth story because of AI and data center growth. You could have growth of 5% or so in power demand, and that could mean high single-digit growth for earnings for the utility sector this decade.
Ben, what are you watching in the week ahead? I'm guessing the Fed, maybe you'll surprise me, butter futures, muffler margins.
I wish I could say milk futures over in New Zealand, but no, it is the Fed. Powell is speaking Fed Chair Powell is speaking in Jackson Hole, Wyoming. We're going to be listening for signs that the Fed is going to cut rates in September and also signs about how much. The market is hoping for 50 maybe, but it's probably going to be more like 25 basis points, quarter of a percentage point.
Okay, Megan, Vice President Harris has been campaigning on her economic plans, including a proposed federal ban on price gouging. How will that work, and will it do any good?
It's interesting. We did hear from the Harris campaign today, actually on Friday, that we are sitting there and going to have potentially a lot more regulation around price gouging, particularly in the food and grocery sector. But unfortunately, I do actually think that this may be a solution in search of a problem. It is one of those scenarios where it's really hard to gauge price gouging, particularly on a national level. And New York Fed researchers actually have shown that a lot of the inflation that we've seen in food over the last couple of years is due to higher commodity costs and, of course, wage gains from grocery workers. So this is something where, again, makes a great stump speech, but we'll have to see, exactly how this plays out. It's a tall order.
Andrew, this is television, no profanity. How do you feel about the plan?
More economic nonsense from the presidential candidates. This is like a dumb idea. There's not really a problem here. It would lead to hoarding and other problems. They try to have a control. This is something out of like Soviet Russia, which he wants to do. Donald Trump gave us the tip plan of exempting tips from taxes, and she bought into that. So this is what we've got right now in the presidential campaign.
Megan, we also got newly announced prices for Medicare for the negotiated drugs, some drugs. Is that going to have more of an effect for consumers?
Well, I want to put this into perspective. So Harris's proposals are very much theoretical. And arguably, again, there's not a whole lot of indication that there's massive inflation or profits that are being done on the grocery side. On the Medicare side, however, this is actually already law, and we have had some movement on negotiations. Now, how it plays out is a little bit obscure on the details still, but we'll have to keep this in mind. It's worth noting, though, Wall Street analysts said this could have gone way worse for pharmaceutical companies, and they actually brushed off the whole endeavor. So we'll have to see. It may be one of those things where we see more progress down the line.
Andrew, I've read that Warren Buffett is buying shares of Ulta Beauty. That's a former high flyer. And you say it's probably not Buffett himself. Tell me about that.
Well, I mean, Ulta Beauty stock got a boost today. The stock had been down about 50% this year coming into the week. It's one of the leading cosmetics retailers along with Sephora. And it got a bump of around 15%. People thought, Buffett's buying the stock. I don't think it was Buffett buying the stock. He has two investment managers that work with him, Todd Combs and Ted Wexler. I think it was one of them doing it. It was a relatively small purchase by Berkshire of about $300 million, but it did get the stock moving. It's actually looking still pretty reasonably priced now. Ulta around 15 times forward earnings.
Was this like $30 shampoos or something? Is that what we're talking about here? It's still upside for the stock.
Yeah, I think so.
Okay. What else is Berkshire doing right now?
Well, one of the key things is the people are watching is that Berkshire's been dramatically reducing its position in Apple this year. It's cut it by more than 50%. But the Apple sales may finally be over by Berkshire. It now owns exactly 400 million shares. And some Berkshire watchers think that round number could be a sign that Buffett is done selling it.
Any other purchases? I mean, they're not buying a whole lot of stocks.
Well,
right?
one of the big news is Buffett is not finding much to buy at all this year. Berkshire's only bought about $4 billion of stocks this year, sold almost $100 billion. Chubb has been the big purchase. They also bought Heiko. And so that's really been about it. And so he's really been sitting on his hands, not buying stocks, not buying businesses, and building a lot of cash, about almost $300 billion.
His favorite holding period is forever, but he's not holding stuff that long, and he's not buying anything. I don't know if we should be worried about that, or it doesn't sound super optimistic, but thank you. My next guest says you could be missing out on big gains by overlooking stocks dumped by index funds. Investing legend Rob Arnott joins me next. Stocks booted from top indexes could be making investors a pretty penny. A new report from research affiliates says that after being dropped from an index, these unloved stocks can outdo the market by an average of 5% a year. Research affiliates founder and CEO Rob Arnott joins me now. Rob, tell me about this recent research on, I guess what I'll call stock index flunkies. These are companies that they get kicked off of the indexes, and you say investors should pay attention to them. Why?
Well, one reason to pay attention to them is quite simply the companies still exist. Indexes will add stocks when they are popular, beloved, expensive, and have soared to a point where they're no longer easy to ignore. Those companies will then replace other companies that are unloved, fallen out of favor, typically trading at deep valuation levels. And the result is these companies get bashed down by the very selling of the indexes to levels that often don't make a lot of sense. So we looked into this, and with S&P deletions, with Russell 1000 deletions, with NASDAQ deletions, on average, they outperform by 28% over the next 5 years. That's a big margin. It's
just the opposite of what you hear usually. Usually people say, hey, it's great news. They're getting added to the S&P 500. It's smooth sailing from here. Everybody's going to have to buy in. But you say, watch out for the reports where you say this or that company's getting dropped, and maybe, but it's not everyone that turns around and does well, right? You have to be working with a large number of these?
No, not at all. Not at all. We're looking at broadly diversified portfolios of these stocks. The index is called NIXT, N-I-X-T, and I believe you can even look it up on Bloomberg. If not, then certainly in the next few weeks you could do that.
Let's turn to the broad market. That was a mighty fast bounce back for U.S. stocks. Should investors be a little nervous about how quickly that happened?
We love finding asymmetries and expectations. Inflation expectations are 2% over the next 10 years. There's way more risk of 3 than of 1. So that's an asymmetry. Could we have 2% inflation the next 10 years? Of course we could. Much more likely to err on the upside. The economy is currently being bolstered by a wealth effect from a booming stock market and consumer spending. But the underpinnings of the economy aren't looking brilliant. The Purchasing Managers Index is in its worst quintile ever. Inventories are in their highest quintile ever. Rate of change of cost of capital, even with interest rates having tumbled recently, on a 3-year basis, cost of capital has soared. And yield curve inversion, short rates being higher than long-term interest rates. is historically a good signal for slowdown. Okay. Plus, the so-called SOM rule has triggered, suggesting we may already be in a recession. The market's shrugging all of that off.
So two risks. Inflation could be hotter than you might think, and the economy could be weaker. What do you do as an investor to protect yourself against these risks?
Well, firstly, I wouldn't say bail out of all stocks. I would say diversify. There's three pillars to successful investing: stocks that allow you to participate in the macroeconomy, bonds to provide reliable income and to tap down portfolio risk, and diversifiers, things like TIPS, the inflation-linked bonds, commodities, REITs, emerging market stocks and bonds, high-yield bonds. A broadly diversified basket of liquid alternatives can give you wonderful diversification. Now, diversification is kind of a regret-maximizing strategy, because in a roaring bull market, you regret every penny you have in them. But when that bull market comes to a grinding halt, you wish you had a lot more in diversifiers.
So don't diversify your NVIDIA with more NVIDIA is what I hear you saying. But what about those big tech stocks? We got about 20 or 30 seconds left. Is there a bubble in the big tech stocks right now, or will AI deliver on investors' hopes here?
AI will deliver. It won't necessarily deliver on investors' hopes, because the hopes and dreams priced into the tech stocks are enormous. The Magnificent Seven stocks are worth considerably more than all of China, more than twice as much as all of Japan, more than all of Europe. That is pretty extravagant. Whoever coined the expression Magnificent Seven clearly didn't see the movie. 4 of the 7 are dead at the end of the movie.
That doesn't sound like a great ending. Hey, Rob, always nice talking with you. Thanks for joining the show.
Thanks.
Starbucks snatching Chipotle's CEO. We'll discuss whether he can turn the coffee giant around. That's next. Chipotle taking a hit this week after CEO Brian Nichols announced departure to Starbucks. The coffee company's stock jumped on hopes that he can brew up a turnaround, despite consumers still getting pinched by inflation. Megan, you are a Starbucks regular. Give us your diagnosis or your prognosis. I didn't go to medical school, whichever one it is.
You know, I think you mentioned that this might be a tall order. I think it actually might be a venti order for Starbucks. I am at Starbucks on a weekly, maybe daily basis. I don't know how much I want to reveal here. And I have to say, one of my biggest issues is their mobile ordering system. And I think that I speak for so many of their consumers that are having issues. They're just not ready. The order times are too long. I mean, I want to get in and get out, have my coffee, go and get to my desk. And that just isn't possible these days. So I think this is a big issue and something that we're really going to have to see some improvement under the new leadership.
Have you experienced abandonment, as the analysts call it? That's where you start a coffee order on your app and then you see the wait time, then you say, forget it, I'm not waiting that long.
Look, I am in New York City. I'm very blessed. We have Starbucks on almost every corner. I have abandoned orders at one store and gone to another on almost a weekly basis. And certainly I have sat there and said, you know what? No Starbucks today. I'm not going to McDonald's, but I will go to the local coffee shop.
Andrew.
I tell you, one challenge he's going to have is that Howard Schultz, the founder, is going to be looking over his shoulder and maybe second-guessing him. And I think that some of the issues they're dealing with, they've tried to fix and haven't been able to do so. It seems like everybody has a solution for Starbucks' problem.
This is not a young company. They have had grown-up mega corporation management for years, so like they've tried it. They put out blog posts about their fancy software systems for figuring out wait times.
But one good thing is they finally have a restaurant guy running the company, which actually could be good news.
And this is a restaurant guy who's had success doing different things. He started at Taco Bell. I think he was the guy that invented the Dorito taco. And everyone thought he was going to turn Chipotle into Taco Bell, but he didn't. He doubled down on what worked for Chipotle and fixed their problems. And I think the hope is that he'll be able to go into Starbucks and diagnose the problems there in a way that other people that haven't been able to do yet.
To his credit, I don't think he Dorito dusted anything at Chipotle. Ben, Chipotle stock dropped 8% on the news that Nichols was leaving, and Starbucks gained 25%. What do you think you do with those stocks from here?
Well, I think with Starbucks, I'm confident that you're going to like where Starbucks is in a year. But with the stock, I'm not so sure, because I think that it kind of priced all that in one day. With Chipotle, I'm a little more excited. I think the stock has pulled back. There were some concerns about same-store sales before he left. Now the stock is kind of priced as if like he was the only person that could run it. There was a strong bench at Chipotle. They have some good things happening. Avocado prices have come down. down. That's going to help their costs. And they're also bringing back brisket for a limited period of time. That should help with the same-store sales.
Andrew, you excited about the brisket or Chipotle stock?
I love brisket, especially at the high holidays. But I'll tell you that I think the stock Chipotle is richly priced now, around 50 times earnings. One warning sign is Bill Ackman, its biggest supporter, cut back his stake in the latest quarter.
One analyst that I spoke with, he told me he thinks Starbucks is fairly valued. He sees more upside at Papa John's. They had a turnaround. It kind of turned into an unturnaround, and its CEO has left for Shake Shack, and one from Wendy's has taken over at Papa John's. It's like fast food CEO twister. I guess we'll see. But Andrew, you point out that there has been sort of broader weakness in restaurants and retail, also including at the high end.
Yeah, what you're seeing is like casual dining has been a very weak area in the stock market and in terms of business-wise, in terms of Dine Equity, Bloomin' Brands, Darden. It's been a tough area. You've had some pockets of strength like Cava and Shake Shack. So we'll have to see how that plays out. Also, the high end is, in terms of consumer, seems to be weakening. LVMH, the leading luxury goods retailer or vendor, has had a tough first half of the year. And even companies like European Wax Center is getting waxed in the stock market.
That's not car wax we're talking about. That's the waxing of various bodily regions, and that one is that's a high-end consumer. That's not.
I mean, it's discretionary. Let's call it that.
I don't know how we got here from frappa lattes. Megan, get us back on track here. What do you see for consumers?
I think Andrew makes some good points. You know, these stocks have been under pressure, but it's interesting because consumers are still spending. We saw a really great, better than expected retail sales quarter this month, which is fabulous, and you know, I think restaurants are actually seeing improvement here too in their sales. So this is actually good news. I think what you're going to see going forward is a cost-conscious consumer. And this is great for value plays like Walmart, who had an absolutely gangbusters quarter. And so you're going to start to see, you know, a certain amount of pullback, but pulling forward on certain areas of spending that are value plays.
Anybody want to take a crack at McDonald's? Consumers, looking to save. I mean, who beats McDonald's on value? Do you think that stock looks attractive here?
Well, the market thinks nobody does. They didn't have a great quarter when they released a few weeks ago, but the stock is up about 12% because they have these value meals that are coming out, and everybody assumes that McDonald's wins a value war. So if you like, it looks like a decent play right now.
Yeah, but I mean, it's not as much of a value anymore. You go to a McDonald's here in Manhattan, you can pay $15 for a meal. So I don't know about that.
What McDonald's needs is Brian Nickel. He sends every stock up 25% a day. Put him at Intel, put him everywhere. I say put him in the whole S&P 500. Okay, thank you all. Megan and Ben have a pair of investment ideas, and Andrew says the diamond business is being roiled by a shiny alternative. Stay right there. Andrew, you say I'm taking a beating financially on that diamond ring that I bought when I proposed to my wife around 170 years ago. What's going on?
Well, what's happening in the diamond industry is there's been the growth of lab-grown stones, which are manufactured diamonds, which are roiling the whole industry right now.
This is different from a cubic zirconium, whatever it's called, right?
These are like, they look and feel like the real thing. You need specialized equipment to tell the difference between natural and lab-created stones. And what's happening now is it's taken the market by storm. It's estimated that half of all diamond engagement rings sold in this country are now lab-grown stones, and it's hurting the diamond industry, which may never be the same.
Are prices way down when people go shopping for rings?
Diamond prices are way down. One of the problems is that the prices of lab-grown stones have been plummeting, and so that's made them more appealing relative to natural stones. This has been hurting De Beers, which is the industry leader, reported weaker sales and earnings for the first half of this year, and the rest of this year doesn't look much better. De Beers is on the block right now by its parent Anglo American and may not get a particularly high price. And then there's this whole issue about, will the cachet of diamonds diminish now that they're no longer expensive and rare? And so
I'll be buying a diamond-encrusted grand piano by the time this thing is done, is what you're telling me.
Exactly. There's no resale market for lab-grown stones, so it's unclear, just how the diamond market's going to shake out here.
Got it. Megan, how about a stock pick?
Well, I want to point out that housing starts may have been really not great in July, but Barron's is very bullish on a really interesting home builder. So D.R. Horton is the pick this week, and in part because the company has such a solid track record. So shares have returned about 25% annually over the past decade. That's a great track record. And I have to say, there are clear skies ahead, if you will.
There's like no houses, and they make houses. That sounds like a good place to be.
It's a good place to be. It's a good place to be. They're great for first home buyers. You know, those first time home buyers. There we go. Got it. Third time. And you know, it's also one of those things where we're going to start seeing housing, you know, really pick up, hopefully, because we've got lower mortgage rates, and we've also, of course, got hopefully lower rates. Period over the course.
Ben.
So I'm looking at a company called Gilead. It's a biotech. It has a very strong HIV business, but it's been dead money since about 2016 when it had a big blockbuster hepatitis C medicine that actually cured it, but then everybody else came along with one.
There goes the customers when you cure it.
Exactly. Right. But they have this HIV business that is great. They have a drug in trials right now that is a prophylactic for HIV, keeps you from getting it. That's looking promising. It had a liver drug get approved by the FDA this week. Looks like maybe it's showing signs of life. I think it looks pretty interesting here.
Great ideas. Ben, Megan, Andrew, thank you. To read more, check out this week's edition at barrons.com. That's all for us. See you next week on Barron's Roundtable.